Good morning. Good morning from Mortgage Rose 411. Welcome this fine day. I am here with my co-host, Kevin Casey. I'm Audrey Boissonou, and Tracey King, who is the COO of Partners Credit, is joining us today because, as usual, change is coming. There is so much going on.
Also, because, by the way, Tracey, the last show we did with you was one of our most requested ones.
Oh, great.
Yeah, no, people keep requesting. It's like, wow, okay. No, let's bring her
okay.
back.
I had like I remember I had a moment where I couldn't think of like a word that was the simplest word of all time. And I remember just feeling like I was drifting off into the Netherlands, just kind of, what am I thinking of? What am I thinking of? So I'm glad so many people get to watch me have a total,
yes.
We didn't sense that at all.
You're in headlights.
Thank you for taking us on that little trip down memory lane, but none of us remember that. So there you are.
So it just haunts my dreams. That's
right. Exactly. You know what? This kind of thing is just, it is what it is.
Right.
And so I just think that keep it real and don't worry about it. Everyone's fairly forgiving. If they're not, they don't tune in. So here it is.
Right.
It is not for everyone, but it's really interesting as we travel around and talk to LOs, and they really want to know what's going on in the industry from an LO perspective, which is what we bring. So that's always our focus. We do loans. What is it that we need in our business? What is it we need to know? What are we like blown away by, et cetera? And that's what we're doing. So, all right, let's take a little, we have an upcoming live NMLS class in Sausalito, California at the Yacht Club, which is the most glorious, beautiful place you've ever seen. And that is happening when, Kevin?
That is Monday, October 24th.
October 24th is a Monday?
Yeah, it is.
Who knew? So that's exciting. We always have fun when we're live. We just, last week we did a live class in Oakland with 75 people and had a ball. It was so much fun. But the point is, it is NMLS season, people. NMLS. You have to knock it out. I'm doing one more online class in November. I can't remember what day.
And you taught an online course on Thursday last week, right?
I did. There were like 168 people on for the California portion and 58 or something like that for the rest of it. And it was actually, it was good. Like people liked it, it seemed. I mean, as much as you can like sitting in front of your computer with your head and shoulders showing the entire time. And there's all these algorithms they're employing, which is just crazy. So I'm very interested to see next year whether as many people think online is as good as they were thinking it was this year, because it has changed.
So they have an algorithm that could tell if I put on a loop video of myself.
Right, I was gonna say,
they do apparently. I mean, I don't know the back end techies part, needless to say, but there we are. Okay, so we have a lot of upcoming speakers that are worth noting. So again, thank you to Tracey, who I love so much. Next week, we are doing with Rick Betancourt a VA session. It'll be part of our update. And it occurred to me, Kevin, that we have never highlighted VA in the over 2.5 years plus that we've been doing this. Isn't that weird? November 1st, can you believe we're talking about November 1st? I can't even, I feel like my life is flashing before my eyes. We're going to have Dr. Elliot Eisenberg, our favorite PhD economist on. He is, you know him, right, Tracey?
Yeah, wild ride.
Oh my God.
On the dance floor, it's something to behold. It's
well, beautiful. You should have been on his on the last time we had him on. He likened the very rapid Fed funds increases to what the impact of that on the economy. He likened it to taking an edible and not thinking it had worked yet, and then taking another one and another one. I thought it was.
Yeah, he has some pretty good analogies. A lot of them reference drugs. So,
oh my God,
no speculation. So funny. I'm just saying, he's tapped in.
He really is. And just for fun, the Feds are talking about raising 2 more times this year, November and December. So I mean, like why give anything time to have an effect on the economy? Let's just go for it.
Make sure it's dead. Make sure it's really dead.
We're gonna wait and wait and wait and wait, and then we'll just sock it to you all at once. All right, so here we go.
As an analogy, it's kind of like a wife who's finally taking vengeance on a abusive husband, and only stabbed him 500 times. It's like,
Oh,
kill that economy.
Wow. Okay. That is that is quite
A different analogy. I'm sorry.
I really don't even know what to do with that.
there.
So let's keep on going. We're gonna have
It just feels like that's what the Fed is doing the economy. It's like, it's not dead yet. Let's keep killing it.
yeah, move it along. Kevin Perania will be here on Election Day, which is November 8th. Laura Brandeo, who is just a little light of sunshine, will be here on the 15th of November. And then Julianne Joseph with FHA, the deputy commissioner. Is she the assistant commissioner or the anyway, with FHA, she'll be here, and she is so great, full of information. And there you go. So we've got a lot to look forward to. As always, will you please let us know if there's something or someone you'd like us to highlight, or something you'd like to know about. We've been trying to give you some ideas of what to do in your business instead of hammering to death what is happening in the economy, which we can just all agree is a real show, right? Right? Okay. Anything else? Oh, I know there is I don't know what day it is. There is a party, a Halloween party in the Inland Empire camp down south. Okay, I'll get it for you next week. Anyway, they're expecting like 100 people. They have all these drinks that they've made and named after the mortgage business. People are going to be it sounds like so much fun. I'm thinking about popping in. So anyway, there you go. Let's get into it, shall we? So Tracey, anything worth talking about in the appraisal space? Like credit. Thank you.
I was gonna say, well, let me see, although we do have an appraisal part of our business, I know that their appraisal bias is a hot topic right now, but not one that I can speak on as
okay,
well.
Wait, you have an appraisal part of your business? I didn't know that.
We do. We
talk
with ARC. Yeah.
What is it?
Actually, it's funny how you talk about that appraisal part of your business, which is in related area. We learned just last week that when we get a POW for appraisal waiver,
not a prisoner of war, Kevin.
Credit, but it's credit driven. The credit scores also drive the POW.
Oh.
Okay, can I just tell you, I had a conversation with, I don't know what his title is. He's like the head of a company, who said that Fannie and Freddie would totally disagree with that idea. So anyway, so I'm going to find out some more information on that, because he said that they would 100% disagree, which I thought was fascinating. I mean, everyone's yes, like, right? I was surprised too, because it was anyway, so stand by on that. It's on my list of things to figure out. And so
anyway, back to what you originally were going to ask, Tracey, how's the credit world going?
Yes, credit, but I also am interested that Partners Credit has an appraisal part. What is that?
Yeah, so it's ARC, and they are mainly focused up in the Pacific Northwest. We do have licensors in California as well. So, we're trying to find a way to keep costs down for everyone. And I know that's something we're going to be talking about as well. And so for many of us, it's been diversifying product base from, flood reports and do this, and we can try to keep margins down in the credit reports because they're so expensive. So it just made sense to merge with the company that's handling appraisals. That's a cost you can pass along to borrowers. What can we do to work together that you can consistently have the same support team, recognizing the challenges that you have, making sure that you recognize, we're here from the very beginning along the way, working with our customers to find solutions. And part of that is AMCs, which I know is not everybody's favorite topic or thing to deal with, but how do we improve that process, especially now? So,
well, I think everyone's looking at costs. I mean, the last couple of years, if you had a problem and could throw money at it to fix it, it wasn't really a problem, right? Now, every penny counts and everyone's looking at that. So let's talk about what's going on with credit report costs, which are about to have a monster hike.
And I want to be somewhat careful about what I say and don't say, but I do think it's very relevant for everybody to hear what's happening and understand where it's coming from. So end of the year, I'm sure you recognize there's always increases that happen every year. That's not necessarily your CRA, such as a company like myself, a credit reporting agency, but we get passed down hikes in price from Experian, TransUnion, Equifax. A few years ago, when trended data was introduced, where there was a pretty significant increase, and FICO also increased scores a bit, but we are now having discussions with the bureaus in which FICO has come to the bureaus and are giving a huge increase, to which there is little we can do or say about it. And when I say huge, I mean, the interesting part of this is that the way that FICO is distributing this pricing increase is they've created 3 tiers. The first tier has 40 of the top lenders out there. Think your big top guns going at it. Then their second tier has a very minimal amount. And then the bottom tier is the third tier. And that is going to be the bulk of our industry. And the difference of the pricing increase between tier 1 and tier 3, tier 3's pricing increase is about 4 times the amount that it is for tier 1. And that's per borrower, per bureau. So get ready for the $100 credit report. And I wish I was joking.
Wow.
That's
okay.
Wow.
So, okay. Is there any way to break that down a little bit in terms of giving an expectation of what to cost, or is it premature for that?
It's a little premature right now. I know we've talked to 2 out of the 3 bureaus. They have been consistent about that. And basically told us the same tier that we were expecting. Now what we're trying to do and encourage others to do, I recently reached out to a contact I have with the CFPB and said, at what point are we protecting the consumer? Because we understand how it impacts the lenders. You're pulling 100 out of every 100 credit reports. You are lucky to get 25 borrowers that go to the closing table. So how are you recouping that cost? That is top of mind for everybody right now as we're scraping the bottom of the barrel. And your credit reporting costs are higher than probably the bulk of your bills that you're receiving, depending on the size of your lender. So with that, it's how are we going to deal with this? And how do you have to eat that cost? And it was interesting. His response was, whereas the CFPB looks at fair credit reporting, that they don't oversee the bureaus or the FICO scores. So well, that's a great question. And that was kind of, for that, what they're doing is or what he said is he was going to kind of distribute this through FHFA to talk to them about, all right, if we're going to charge this much to the borrower, we really need to make a decision here in regards to, can we have a 2 bureau credit report? Do we need all 3 scores? Mm-hmm. The big topic that's come up, and we discussed this a little bit, is having some diversity and being able to have a choice between Vantage score and a FICO score. But from my understanding, it's looking more like you have to offer both than have a choice, because to have a choice, you'd need to set up parameters of, okay, if a FICO score of 580, what is that equivalent to for Vantage? And I think that they're understanding how complicated this can be ahead of the game. So if we have 2, then that's an additional cost. That's not necessarily saving you. It opens up parameters, so they say, of the type of borrower and what you might be able to get a score for. But at the end of the day, it's still the substantial cost to us as an industry and how we deal with it. And it's the first main step that you have in your loan process. Right. There's no way around it. So what are we going to do? So I do hope that people, if you're involved, if you're working with state legislature, if you're doing anything, this is something that needs to be, I think people just think credit is there and it's annoying. I mean, when I started, so I've been doing this now for a long time. 19 years. 20 something, I don't know. That the cost of the credit report was $8 and $13. Right. That we would charge to our customers. The fact that is, that's a pipe dream. It's quadrupled, quintupled, right. And now it's almost going to double this year. So
Okay, so there's a few things about this that drive me a little crazy. So first of all, the bureaus are selling all of our personal information without our permission and profiting big time. So I don't understand how they can justify an increase like this. It's completely insane to me. And especially at a time when, we're headed into a recession, if we're not already in one, they just haven't announced it yet. We have an industry that is just getting slammed everywhere we turn in terms of everything. And so to jack up a cost to this point, how
right. I can't believe they're doing, I mean, my stomach was in knots all last week as I heard this come out, because it's now how we manage this and how we do this. And you need to get creative and start working with your CRA immediately, of how you as a company can do as much as you can to drive down these costs, because it's just going to eat into your profitability if you are
assuming you're having a profit this year.
Right. Yeah.
God help you.
So one of the things I've heard some companies are doing is they're running a soft pull first. Right. And how do you see many companies doing that out there, and then can they run a DU with that soft pull? I've heard some are saying they can. I've heard some say they can't. And
what is the price difference between a soft pull and a hard pull? And then do you get a credit towards if you run a soft pull in the beginning, let's say, because what Kevin is describing is a company who told us that they are running a soft pull and basically just using that all the way through the entire process, and they don't pull a full credit until the end. So I'm just curious how viable is that? What kind of, okay, yeah. So what kind of difference in price is there between a soft pull and a regular credit tri-merge? And what could be different from the beginning to the, you know what I mean? What do you think about that idea?
So there's lots of, a few different things that you've mentioned. Pre-quals, we call them pre-quals, soft pull. Those are great because it helps you in terms of cost of the first people walking through. It helps you because it's not a hard inquiry. It doesn't send out trigger leads. So your competitors aren't all over that borrower, which right now is such a huge issue. And I know something else we're going to talk about. It's a fraction of the cost. And so I know someone put in here, it only pulls in one score. Not necessarily. That's something that your company has probably negotiated with your CRA. You can technically pull a tri-merge pre-qual. It really just depends. You don't necessarily need to do 3. Our customers tend to do 1 or 2 because loan officers tend to be a little sensitive about, well, how do I know if this scores one way, sometimes the next scores, 30
completely the other way. Yep.
Totally different. Yeah. Yep.
So a lot of people like to do 2. The issue with them is that you cannot reissue. Now, Kevin, to your point, right now they are piloting having those pre-quals be reissuable. Fannie will not work directly with us per se. They have to reach out to lenders to ask them to be in the pilot program. So if you've talked to someone that is able to do that, they're probably in that pilot program. So that can be a major way to move these forward and give progress to it, because as we know, loan officers also like to reissue that credit report right away to see what the findings are and what's available to you. So that's been a little bit of a hurdle for a lot of companies who want to implement this as a cost-saving structure, but LOs are hesitant because they want to get to the next step. And I know part of what we're talking about is how we need to adapt to this market and how we need to look at the cost that we are putting out there. What I would say is that credit scores are fluid, and you cannot issue from a pre-qual, you cannot give a firm offer. So I don't know how people would utilize that for an extended period of time. So when you do want to offer give a firm offer, whatever, you have to pull a regular credit report again. So there's a different hit that it gives. You have to utilize those scores for that credit report. So the longer, you have, there's a possibility that those scores are going to change. And also you need to know how you're working with the borrower.
So we have a bunch of comments here where people who are using this and they are using soft pulls, some of them are saying they only use one score. Someone else commented that it was $10. It's not a credit towards the final credit report.
Right.
And someone else said their credit vendor has decreased pricing on reports. Is this increase across the board? So if people are trying, I mean, if somebody got a price decrease recently, it doesn't reflect what is coming directly from the bureaus, right?
Correct. I think that what a lot of people have been feeling right now is your institution has probably reached out to their vendors and said, we need you to lower our costs or else we're going to move elsewhere. You know, right now, everybody is feeling the burn. And I know for ourselves, we have a lot of people coming out with an RFP that it's just, I need to see what else is out there. And so then you're competing with yourself at times to maintain. So that was before we knew what was coming. And if you had them sign something that said this will be effective for next year, good on you. And those places are probably sweating because they would probably be going into a negative margin based upon the increases.
And when are these price effects coming into place?
Good question.
When is it?
Yeah.
So from what we understand, December 26th. So I'm sure most credit reporting agencies will have it effective January 1. Experian did their pricing increase later last year. So I'm not sure when it will be in effect for them, but for TransUnion and Equifax, it's December 26th. So
they may not all hit at the same time. It may be spaced out. So so first of all, you said RFP, just remind everyone what that acronym means.
I know, and I said it to you, request for proposal.
Yes.
So yes, they go out and ask everybody to kind of come in and give us your best offer.
Well, just know that I am hyper aware of this because Kevin's always reminding me that I cannot just use acronyms. I have to explain what the heck I'm talking about.
I know, and then I get heart palpitations because you get so used to using the acronym, you start to forget what it actually means.
What the heck it costs. It stands for. Yeah, I hear you. Yeah, I hear you. Okay.
But everybody's price will be different for pre-quals. For us, they tend to be $3 to $6 for an individual joint for one bureau.
Okay, hang on. $3 to $6 for one person with one bureau?
Correct.
Okay, so
one person would be like $3, two people, it would be $6. And then, typically double that for two bureaus and then three bureaus. But again, that's something you probably negotiate with your CRA and they can talk.
I'm sorry. What is CRA again?
Credit Reporting Agency.
Very well done. Excellent. Okay. Just in case anyone is wondering, just want to make sure. Okay. So someone was saying that lender, they did a soft pull for almost all the refis they did, and the full tri-merge was done before you ran AUS and locked it. But I don't really understand how long can you wait to run AUS? I don't understand how, but the pilot program you're talking about, maybe they can run AUS on a soft pull or in a
That's what they're looking to do. And to be honest with you, that would get us pretty far. And in terms of our expenditures of the 75 out of 100 credit files that don't go anywhere, we can do a soft pull on that and get an idea of where that borrower would fall, be able to talk to them about options. Yeah, that could really, however, as I say that, there are scores on the pre-qual report and those costs will be increasing as well. So I don't know what the new pricing structure will, CRA also stands for the Community Reinvestment Act. I found that out one time where I was like, why is everybody saying this? This is my thing. But yeah, the FICO score, it's going to impact pre-qual reports as well. So those will probably double. But at the end of the day, if that is less expensive than these huge tri-merge costs, we need options there. And someone asked if this increase in costs was caused by the fight between the CRAs and Fair Isaac over the development and use of Vantage scores. I don't know because it's FICO. So FICO is in competition with Vantage. I do wonder, and what I have heard around where Sandra Thompson was going out and having huge interest between Vantage and FICO and what people were interested in, if they wanted a choice or if they wanted both. And at first she was very much into the pick one. Now what I've heard, and I was on a webinar a couple of weeks ago, and I wish I can remember this gentleman's name, but he said that he had heard that once she started speaking to lenders and found out how challenging that would be, it sounds like now they're looking back to FICO to see if there can be updates made for their scoring model, which is asinine because they have so many different variables of FICO. So the fact that it's, you know, mortgage based and I don't know. So I don't have an answer for that.
So I think I know the answer. I'm going to ask it anyway. Who is behind Vantage? And who's pushing for Vantage?
Vantage was created by the 3 credit bureaus to, right. Yeah.
Okay.
It's all incestuous and yeah. But that was how it was created, to kind of create this even keeled place. So
why would they create their own competition? Just out of, if we have any idea.
It's not necessarily creating it. It's kind of saying, well, how do you pick one outside of the other? And it's trying to make something that was blended and equal. So, you know, at the same point, it's creating their own scoring model versus having FICO out there. Now you guys are going to start asking me about the origins of FICO, and then I'm going to have that dead look in my eye because I don't know.
How was the earth created? Did it really happen in 7 days?
Lord, I don't know. What's my audience here? How can I?
No. We're not even going there. I shouldn't have even. So yeah. So okay. So yeah, it's a lot to digest, isn't it?
It is.
Okay. So someone said that the FICO 2.4, and by the way, Kevin, didn't we have the guy who helped create FICO originally on our show, like during COVID lockdown with Terry? You know him, Tracey. He's the head of the credit association.
Yes, right.
Terry,
the NCRA.
Yeah, Terry. What's his last name?
Mm-hmm.
Great.
Clemens.
What?
Clemens, right?
Thank you. Yeah, great guy. So he came on with the guy who actually worked on FICO originally back, you know, like when it first started. So, and he was still working for them. So I don't know how it all started. Who the heck knows? But it is definitely in transition, guys. So just keep an eye out for this. And this pricing thing, I'll bring it up with NAM and see if it's anything they want to weigh in on. Yeah. I find it a little, you know, you've got Fannie and Freddie who are making, I'm curious to see their quarterly earnings, just because they have to have taken a monster hit this last year too. But they have had such huge earnings, and the LLPAs are out of control. And now we have this. And meanwhile, they're all screaming affordable housing from the rooftops. And I just don't understand how they're just talking out of both sides of their mouths, in my opinion.
Yeah. And you know, what's interesting, and I know this is one of the topics you wanted to talk about, was that Equifax came out and said that they're adding all this new data to their credit reports and talking about, you know, I guess it was like TV utility bills and how that would be added. And they're first in the industry to do so, which is questionable because Experian did something similar a few years ago called Experian Boost.
Right. And it was optional.
It was optional. It's something that the borrower had to opt in for. And so the borrower would go in and do that. So Equifax put out this announcement that they're adding that a lot. And so if you read the announcement that came out, everything said alongside the credit report. And I had reached out to my rep with a few questions, such as, do they opt in? Will this impact the credit score? You know, all the things that we all want to know. Right. And she said, please hold. We have a call next week to discuss these things. So it's kind of the cart before the horse. They're putting it out there. No one has specific answers for it. But if it is similar to Experian Boost, again, it was all smoke and mirrors, because Experian said, improve your credit score, and this is going to help you. Well, not really, because it wasn't the FICO mortgage score that we use. So it doesn't help the score for mortgage borrowers. And it will show there. And a lot of times if there's a thin file, you would add those via a supplement anyway, but it looks like it's kind of be doing the same exact thing if I'm guessing correctly. I would highly doubt that this would involve or impact the credit score. I don't see how it could.
Yeah, I don't see how it would either.
For Equifax. And also to Audrey brought up to me, what about the people that kind of pay those haphazardly because, okay, I need to pay this bill because I know that that's going to be on my credit report. So I can be a couple of days late for my gas bill and not have it impact me. So yeah, to Ginny Ferguson, she's hot on the column right now, talking about it's really up to FHFA and Fannie and Freddie. It like once they decide to make changes, we can start implementing there. But everything's all prepped and posed and ready to go. Trended data. Why don't we look at things a little bit differently of payment patterns and how people do things? Utilities. And again, those things go differently because typically in Experian Boost, you couldn't have like a rental payment history on if you had a current mortgage. It's all very muddled. Once you get into like the fine details, it seems like it's presenting itself as helping for, reaching out to these lost borrowers. But what impact does it actually have? And how can you as an LO utilize them? It's just kind of giving you like, here's an idea, now figure it out. And we all know we're used to doing things a certain way. Someone needs to be the voice to say, okay, here's our starting point. How do you follow it through all the way down? And that's what we're lacking right now.
Well, I think too, the messaging needs to get to the consumer. If the credit reports and what is being reported is changing, we need to be shouting that from the rooftops to let people know. Because I know people with very high credit scores who are very loosey-goosey with paying their utility bills because it's not a big deal. And so, I mean, can you imagine somebody who's always an 800 score and all of a sudden they're a 630 because their PG&E got paid late? And by the way, when PG&E is now $1,400 a month for some of us, it's crazy, you know? So I think that there are so many issues around this that I just want people to know about them so we can get ahead of them. And again, when you're looking for some sort of information to share on social media to make sure you're adding value for your clients, this is a good little nugget. These things could be coming. Make sure you're ready as a borrower and give them material things they can do in their own lives that is going to make their credit profile better, because so many people don't have a clue what goes into a score, even, let alone these kinds of changes that are coming that could really impact folks who've never been impacted before.
Well, a lot of people think, oh, I just have bad credit. I'll always have bad credit. And it's amazing to them when you start exploring to them and explaining how their credit works. And, oh no, you can create, clean up your credit and start making payments on time and do all this stuff, and your credit scores will rise. And I mean, I've had people that, have had a bankruptcy and had a, sub 600 credit score, and now they have 800 scores and they're great. Yeah. So
you've got to coach.
I think that's key is right now. And we talked about this a little bit last time. It's a different environment and you need to adapt. And part of that is the long-term goal of keeping that borrower, showing them your value and what you can bring to the table. So if they have a subpar credit score, before, when you were so busy, it was like, okay, no, I don't have time for them. I don't need them. Take a moment and learn the value set of, how different attributes can impact the score. Utilize tools that you have available to you. A lot of people have credit expert.
Just did that last week. I had a client who was declined by one of the big banks, came to me, and their credit score for the big bank was 596. And I did re-pulled it and then did a rapid rescore. And so here, no, just pay off these two credit cards. And you got a 636 credit score. With that, I can do something.
Yeah, it's crucial to learn. And again, I can't say it enough. It does not take that much time and effort to learn that and to utilize that, or to use somebody else to help you with that, that it is going to make you stand out. That borrower, if you slow down and don't start talking to them about basis points or I can save you a point, they don't know what that means. They want to know, hey, look, you're right here. We've got a goal. When do you want to get to that house? Do you have the house? How can we get you there quicker? And if we don't get this house, what does it look like down the road? And how much will it save you? If I can get your score up 20 points, what does that look in the end of how I can get you a better loan? Speak to them in a language that they understand. Nobody wants the rapid fire, response that makes, maybe around your peers, it sounds really fresh and cool to use all the acronyms and the BIPs and the, all of that. But at the end of the day, people want to feel safe, comfortable, and they want to trust you. And gaining that trust is, how can I get you into a better place? And that's understanding their credit. It's the starting point. And it's also where people feel the most vulnerable. Are they judging me because of my score? Are they judging me for your debt? And you don't need a credit counselor or credit repair company to do that for you.
Right.
One of the things that we hear a lot of people say, oh yeah, you can always have an 850 credit score. And I'm like, I don't think it's possible to always have an 850 credit score. Maybe with, the credit card scoring systems, it's possible, but not on the mortgage side. Because, Audrey and I were talking about this before the webinar, like, have you ever had a client with an 850? And I'm like, no, I've never. Maybe an 825 on a really good day.
830 something, I think.
Yeah,
I've seen
but on a mortgage pool, I'd never get all three bureaus, at 850. It just doesn't happen.
Do you study all the credit reports, Tracey? Tell us what you're seeing, because we want to know.
I do not study them. I probably knew this better back in the day when I looked at them all day. But when you do pull a credit report and you're looking at the credit score, it should say on each bureau what the score.
The range is exactly. Yeah. And I don't see that range going up over to 850 on all of them. One of them, and the rest would be like 836, 824 for their maximum.
And God bless you if you're still getting those loans. But I know last time when we talked, we were looking at the average credit score, or maybe it was a different call, but year over year, the average has declined about 10 to 20 points, depending on the bureau. Mm-hmm.
Well, that makes sense though, because anyone who had like the creme de la creme of credit scores probably refinanced already. Yep. And then you've got this. There's a couple quickly. I just want to say, we have a very brand new YouTube channel that one of our buddies has uploaded a number of our recordings on.
Thank you, Jason.
Yes, thank you, Jason Bellevue. We really, really appreciate it. He just took this upon himself and did it, because we've had so many people asking, and it's always a little tricky forwarding recordings to see and knowing whether they work or not. So Mortgage Pros 411 on YouTube, if you want to go back and review some of the recent recordings. I think we've got them in there since June or so. I don't think they're in date order, but he put the flyer on top of them with the date on it and who the guest was. So it should be fairly easy to see. And then somebody was asking how to register for the weekly meetings, and we send out the flyers. And once you're registered, I'm not sure what happens. It only allowed me to extend it through a certain date, and then I'll have to re-up it. So we're working on this back end stuff, which is so annoyingly tedious. It's unbelievable, but we're getting there. So little by little, guys, thank you so much for hanging in there. But it made me think of that because someone was saying they had to go to a meeting. Okay, so to recap, we don't know when this is going to affect exactly, but probably towards the end of the year or beginning of next. Yes.
Which part?
The price increase.
Price increase, yeah. You would be seeing it probably January 1st.
Okay, so quoting higher prices, not yet, correct?
Not yet. Imagine all your credit reporting agencies are trying to take deep breaths and figure out how to break this news and what it looks like. And we're hoping, speaking of Terry Clemens and the NCRA, we're hoping that some pressure, once people have this uprising, that they put the pressure on to see if anything can be done. It's likely, but we're hoping for the best.
Good.
Okay, so someone made the comment, Boost is, Mark, thank you. Boost is terrible for people with high debt ratios, as you now have to count all the utilities against them, which also speaks to somebody else's question about, do you have to then include those payments, those utility payments in the DTI? So holy guacamole.
Yeah.
Be careful. Be careful with that. So if it's on the credit report, it looks like it's in the DTI, even if it is a utility bill. Yeah.
Yeah. So yeah, once we get further information, and like I said, I'm waiting to hear back from our rep. I can provide that to Audrey, and I don't know how you send things out or whatnot, or you can get my contact information. I'd be happy to share that information.
Okay. So someone is saying they said you don't include it as it's paid off monthly. Someone else is saying that the utility bills are excluded from the DTI. So those are two different comments. That's interesting. Yeah. So, all right, well, there it is. So most lenders let you omit utilities, Christina's saying. So we'll do a little more digging on that.
Insurance,
I bet I imagine it has to do with how thin the file is, because I know for us, a lot of times people are adding on utility if it's so thin that they need to kind of bring that into the equation. So.
Okay. Well, I talked to somebody who had done their loan at Bank of America, and the Bank of America underwriter had gone through their bank accounts and bank statements, and seen that they were paying pet insurance, and the pet insurance was included. They did include it in the DTI. I have a feeling that it depends on the lender is basically what we're seeing here. We have one person who says that it isn't. We have a few people that say it or say it is versus it isn't. So it probably varies from lender to lender. There's a question here, Tracey. Have you noticed over the past 5 years that scores in general are lower? He's saying that he used to get a lot of borrowers with 800 credit scores, and now it seems like the best scores are high 700s instead. Do you know anything about that?
I don't. I'd have to go back. I mean, we have that data to look at, but what I had seen, it was basically the boom for us in 2021 and where it was now. Right. But, I think it really just depends on the market. The market reflects kind of where people are and why people are doing what they're doing. Are they refining?
Right. I think who we're dealing with right now are clients who, anyone who had the 800 scores, they already did their refinance, they're set, they're not doing anything. And now we're getting people that, for whatever reason, missed that opportunity or are now buying. And, the great thing right now is I think this is one of the best buying opportunities we're going to see for years. Right now, because it's just, there's no competition. I have a client who's, asking for the world with their offer and getting, 2% credit back from the seller and, all these other contingencies that you couldn't have gotten. The only downside, and Audrey and I talked about this, is we're starting to see so many more deals fall out of contract. I had one last week that fell out of contract because they had an inspection for mold, which I'd never seen someone do an inspection for mold, but they found
in the air conditioning, right?
In the air conditioning.
Oh, wow.
And so therefore they pulled out of contract, and so we're seeing a lot more deals pulling out of contract than we saw in the past.
But my comment about that was a year ago, those people would have bought that house with no inspection and then found out they had mold in the air conditioning. Yeah. And so when everyone's freaking out that there are cancellations, maybe it's for a good reason, and maybe it will give sellers a reason to make sure that their properties are in order before they put them on the market. Mm-hmm. But it doesn't mean it's necessarily a bad thing. It means that buyers can go in and have an opportunity to find out whether the property is what they think it is. And that's not a bad thing. So if we look at it like that.
It is on my bank account.
Okay. All right. Fair enough. No, I totally hear you. I hear you. It is painful when our deals fall apart, but I mean, hopefully they,
especially with 3 days to close. What?
3 days?
3 days for close. They found the.
Okay, that's not nice. So yeah, so there is a comment in here from someone who said that they got a PIW for a cash out loan on a house that has been free and clear for 50 years and have great credit. But then they have another client who refinances all the time. They never get a PIW no matter what. And their credit is good too. So it is, we agree. PIWs, it seems like there are less of them. I mean, I don't know if everyone agrees with that, but I feel like there are less of them than there were. And it is something that lenders are really looking at right now as prices moderate. They're not plunging. The year over year increase was still up 0.2%. Fannie Mae's home price index for Q3, 13.2% year over year. So they're still up year over year, and that's what we look at. They're just moderating. So hopefully they moderate. And still no one is expecting it to be a disaster or be a big price decrease, but it is something we need to, we need to keep an eye on.
Something that came up on that class we were teaching last week in Oakland was that when you do a PIW on a purchase, you don't want to automatically just tell the client, oh, we don't need an appraisal.
Oh, sure.
That you need to give the client the option to still have an appraisal, hand deliver one, because they know what the value truly is. Because the PIW is just saying, well, we don't need an appraisal versus, well, how am I sure that I'm paying what I should be paying?
Right.
That's a different issue for the seller.
And again, the last few years, it really wasn't something that people cared about. They were like, whatever, I just want this house, I'll do whatever. And again, do not forget, I keep saying this, but I'll be a broken record if I need to. Remind your clients or these people that they were willing to pay $400,000 or $500,000 over asking price. Why is the interest rate such a big deal? I mean, I know it's a big deal, but you know what I mean? Okay, so couple things. I thought this was really interesting. There was this comment that the bond market, so there's all this criticism around cryptocurrency and all of those indexes about how volatile it is, right? They're up, they're down, they're all over the place. The bond market has been in the last few months 7.6 times more volatile than cryptocurrency. And I'm like, yeah, we all feel it. So if you're all feeling like you've been dragged behind a truck for the last few months, you have. Okay, so I wanted to talk about something else. So there's a lot of people who are remote working. We get it. And we thought it was going great at first, and there seemed to be some chinks in the armor. So first of all, we have seen the studies that are showing that people who are remote workers do not build the same relationships that people who are in the office face-to-face build, and therefore are often likely to be the first to be laid off. Mm-hmm. We are also seeing, hang on, I wish I could find my little thingy on this. Equifax found they used their own software to find that there were people in their company that were double and sometimes triple dipping on jobs. So they'd have 2 full-time jobs or even 3 sometimes. And so anyway, Tracey, you and I were laughing about this because one of them was they found out because the guy gets on a Zoom call wearing medical scrubs in a medical environment for an Equifax, who's an Equifax employee showing up for his, and so hello, duh, that makes sense, right? But they're using the work number to figure this out. And actually it was funny because a few days ago I had said, I'm wondering at what point people, employers start saying, I want to see your tax returns from last year showing that you weren't working an extra job and that you were, right? So I don't know, but I hadn't even thought of the work number as that being a way that they can check on people. So here's a little word to the wise, folks. If you are double dipping, do not work for 2 companies who are using the work number. That's for sure. Right. But they all have different ways of figuring this out, right? I don't know. Anyway, just
that's been going on long before Zoom, though. But now it's a lot easier with Zoom, where you could be, on one screen and heck, I've had it where I've been on 2 Zooms at the same time.
But that's different, Kevin, right?
Yeah, but I think people are now making sure that they're making their employees show up on screen for those very reasons, where people used to say, I'm uncomfortable being on screen. It's kind of like, well, I don't care. And you have to show up and I need to see where you are and you're not, driving around the mall.
Okay, so we have a request and it's actually on our list of things to talk about, the medical debts and collections. And so the changes that went into effect on July 1st, and then also the changes that are coming. So we know that if you have a paid medical collection is no longer supposed to show on your credit, correct?
Correct. That was effective July 1st. So anything that was paid should no longer be included. So removing those collections should have helped improve some scores, dependent on what scorecard the borrower is in. But for the majority, it should help improve the score. So then also effective July 1st, it was the time period before unpaid medical collections would appear, would be increased from 6 months to a year. So it's giving people more time to pay that off. So it should not appear if it's within a 6-month window. And then in the beginning of 2023, there will be, if they're under a certain threshold. So I don't think it's been defined yet, but probably $500, it will no longer appear on a credit report either. So that's still upcoming. That's one last rollout to that plan.
Also in July, it came out that for us, we're able to blend the credit scores now when we're doing loans. I don't know if that affects you on your side, but Fannie and Freddie are allowing loan officers to use a blended credit score versus the lowest of the two credit scores for two borrowers. But it doesn't affect the fees on the price level adjustments. So if you got someone like you have one borrower with an 840 credit score and another borrower with let's say a 640 credit score, they'll blend the two and now it's 740. So they qualify, but they'll hit them for the 640 credit scoring on the fees to the loan level price adjustments.
Interesting.
Yeah.
So what's the point?
I think we're going to need to, that they don't handle that at the credit bureau,
Right.
At the,
but on the underwriting
level.
side.
But yeah, I think we're going to need to find someone who can speak to that a little better. Don't you think, Kevin?
Yeah, that would be interesting for an underwriter point of view.
So I have so there's a great question here. So if you have your credit bureaus frozen, and your credit frozen at the bureau level, can they still sell your information as a trigger lead?
I believe, yes. So it's different than opting out. So I know that was something that you wanted to talk about as well. When you freeze that helps prevent you from fraud, from someone pulling your credit. So if you as a lender went in, you pull the report, it's frozen, it's not going to send trigger leads out, but you have to unfreeze it in order to pull it and have them. So that's protecting you from something very different. That's a fraud preventative, and ultimately you have to pull that. And then, here comes everybody calling you to try to get your business. Opting out is a separate piece. So opting out is you can go to a website or call and dial in. And that's when you want to remove yourself from your information being distributed from different lenders. So I know people have been asking about time for that and how long it takes to go into effect. So this is kind of like the tip that we've been talking about, because so many people feel bombarded by, my borrower almost feels harassed and they're coming to me like I did something. So one of the things we've talked about as a tip is that a lot of you are working with realtors. And a great thing to do with the realtor is to provide them with the information on how to opt out so that the borrower can go ahead and do that at the very beginning when they're starting to work with this realtor. From what they say at the opt-out website, it is 5 days that it takes to go into effect. I have heard that it can go sooner, but give yourself the 5-day threshold. Usually they're going to say they're going to give themselves some cushion there. But they say it'll be 5 days. And the only time you might still get some information is if your information's already been sold and they're waiting to send you a flyer or something to that extent, but you're not going to have the rapid fire phone calls and barrage of text messages.
Yeah.
I had a client who was a business person, and he said he got, with the second I pulled credit, he felt like there was 50 phone calls coming through. Oh yeah,
it is. And I'm sure lots of you do this. Yeah, I know. I was at a meeting last week where people are talking about how they handle leads, and they were buying leads from Zillow. And they have, I think they called it like 5 under 5, and it's having 5 points of contact, different points of contact, and connecting to that borrower within 5 minutes of getting the lead. So
those lead guys have it down to the second, no joke.
Yeah.
And I just read that every lead that's generated, there's like 20 leads for every closed transaction. It's crazy. And so they're selling those leads to hundreds sometimes of people at the same time. It's just, it's crazy. Yeah. That's why we've heard of borrowers getting up like 78 phone calls or 78 solicitations off of one lead. So the
website we're being asked for again is optoutprescreen.com. That's the government site.
Yeah, I'm typing it into the side and also the phone number that you can use to call.
I know we keep joking around about when you're putting the phone number in, when you're ordering a credit report, that you should put the complaint line for the CFPB's phone number.
Yeah. Although those aren't connected. And I actually was at a meeting with the CFPB and someone came up and they're like, what can you do about this? And they say, that's not our area. Like, we can't do anything about it.
It's so relevant in our business.
I love that, putting the phone number
in their area. What'd you say, Kevin?
I was saying, I love the idea of putting the consumer complaint number of CFPB.
But now we don't. Now we know they don't care, which is not great.
They don't care. They don't call it.
Oh my goodness. Okay, so there's a whole bunch of questions. So number one, someone is talking about solar lease payments, and those are still in the DTI. And yeah, it's the mortgage business and underwriting, so don't look for logic. It is what it is. So yes, they always include the solar payments. It is, there you go. So somebody's asking, what about settled medical debt? Will that show settled versus paid to zero, I guess? But settled, it was have a zero on it, right? So does that,
if it was like a charge off or settled for less than full, I mean, as long as it's zero and they settled it, it should be removed. Everyone's saying that they can't see the website because I think I sent it to hosts and panelists. I guess I need to send it to.
So it's optoutprescreen.com. optoutprescreen.com. So there you go. And actually Jill had posted that on there. So there you go. And there's also, you put a phone number in there. That was nice.
Yeah, but that just goes to me and you, I think. I don't
think well, if I was really smart, I'd be able to share it with everyone, but I'm afraid I'll screw everything up. So
I'm okay with screwing things up. I'll go with it.
Kevin will do it. He's good at that stuff. Thank God.
888-567-8688. So 888-567-8688.
867-5309. No? Okay, so there were a couple of last things that we wanted to talk about. So you were going to talk about the Equifax changes to the work number. So let's talk about that for a minute.
Yeah, so the everyone should have heard about this by now as well. So Equifax, who owns the work number, they have implemented.
Good to know that, by the way. Really?
You didn't know that? Yeah, they have their fingers and everything. So they are updating the way that they handle. I just saw a little black cat walk by that got me distracted. Very Halloween-y. But so they're changing. Previously, when you would order something through the work number, you would be able to select if it was a current employee or a previous employee. So coming in the next couple months, depending on who your provider is for that, they're now giving you everything. So whether they're current or previous, and it goes back 36 months. So some people are a little bit perturbed by this, one, because they are doing a cost increase, and two, because a lot of times we have to go back 24 months, not 36. So you will be charged if you have, before you'd get a charge for current. And then if you went back and wanted previous, you'd have that. Now you get charged for both if they're both there. So a lot of people are a little bit frustrated by this because you will probably see that pricing increase. So again, that's something that you should really talk to your provider about. I know for us, and this is not to sell me, I want to give tips on everything, but we offer a cascade. How are you looking at how you're obtaining that information? Also, increasing with their prices are their manuals. So there are some that are in their database and they have to be used by, someone works at Bob Evans. Bob Evans only releases information to the work number. Can you tell I want pancakes? The other is that it could be mom and pop shop, and they will go out and call mom and pop shop to get that information. Also look at how you're handling those. I know there's a lot of mismanagement and a lot of people go in and just order it because they think it's easy to do it in there. That can make a difference of $50 per borrower on what you're ordering all the time. So make sure whoever is doing that, your processor, just pay attention to that. That's important to look at. Those things add up very, very quickly. And as we're looking at our P&Ls and seeing where we can cut costs, that is something that has come up quite a bit for my customers.
All right. Well, so costs are increasing everywhere. What a shockerooski, right? So on that bright note, so let me know if you'd like Tracey's information. Her name is Tracey King. She's with Partners Credit, and I'll put you in touch with her if you are interested in talking to them about credit. Tracey, thank you so very much for being here.
Thank you.
We're so grateful that you're always willing to dive in and help. Please keep me posted and let me know when you get the updates from the bureaus on the upcoming, whatever they're about to head. And also, if you see anything that I don't see, which just let me know, where you've got some place that is objecting on a widespread basis where we could all either, you know, vote or send a comment to a legislator or whomever. Okay. All right. So with all that, thank you so very much for today. Thank you, Kevin.
Thank you, everybody.
Have a great week, everyone. Just keep your eye, we're almost there. We've got another month of crazy inflation numbers probably, and then maybe it will start to moderate, but you know, you never know. So let's just look for ways to increase our business, and we'll talk about VA next week in addition to everything else. Have a good week. Bye, guys.
See you next week.
Bye. Thank you, everybody.
Thank you.